Right now, at this very moment, someone is sitting at a trading desk in New York, pricing silver at $71 per ounce, but in Shanghai, industrial buyers are paying $79.50 for the exact same metal. That's an $8 premium for something that should cost the same everywhere. On January 1st, China removed 400 million ounces from global supply, overnight. The paper market hasn't noticed yet, but the physical market is screaming. 31 million ounces in COMEX warehouses, 140 million ounces in outstanding contracts, 4.5 paper claims for every single ounce of real silver. This ratio has never existed without triggering complete system failure. And Venezuela's 74 tons of gold sits perfectly positioned for what comes next. Welcome to Currency Analyzer. Now, before we go further into what's unfolding in real time, I need to ask you something important, the way I'd ask a trusted friend who's seen a few market cycles. Have you subscribed to this channel yet? Because what we discuss here isn't entertainment, it's not speculation, it's documented economic analysis, the kind of information that institutions prefer you don't connect together. If you value understanding how markets actually function, beyond what financial media presents, take a moment, click that subscribe button. It takes 2 seconds, but it ensures you don't miss the next piece of this puzzle. And please, tell me in the comments below, where are you watching this from right now? Are you in the United States, Europe, Asia, Latin America? Because what's happening in silver markets affects every economy differently. Your location matters. Your perspective matters. Let's continue. On January 2nd, 2026, a derivatives trader in Lower Manhattan opened his morning position report and saw something that should have triggered immediate alarm. Silver futures contracts were trading at $71 per ounce on the COMEX exchange, exactly where they closed the day before. Nothing unusual, except that overnight, the world's largest silver producer had just implemented an export licensing system that effectively removed 250 million ounces from global markets. The price didn't move, not a single dollar. This trader, like thousands of others, was operating inside a system where the price of silver has almost nothing to do with actual silver. The COMEX, the commodity exchange in New York, operates on a 2-tier inventory system that most investors have never heard of. There's eligible silver, which sits in approved warehouses but cannot be delivered against futures contracts. Then there's registered silver, the real ammunition, the actual metal that backs up every paper promise flying through the derivatives market. In May 2020, the COMEX held 102 million ounces of registered silver, a healthy cushion, enough to handle normal delivery demands. By January 2026, that number dropped to 31 million ounces, 70% gone, vanished over 5 years, while nobody was watching. But here's where mathematics becomes dangerous. Each COMEX silver futures contract represents 5,000 ounces of physical metal. Right now, there are 28,000 open contracts. That's 140 million ounces of silver that traders believe they can demand for delivery. 31 million ounces in the warehouse. 140 million ounces promised on paper. 4.5 claims for every single ounce of real metal. This ratio has never existed in COMEX history without triggering systemic failure. Never. In 1980, during the Hunt brothers crisis, when 2 Texas billionaires tried to corner the silver market, the paper-to-physical ratio hit 3-to-1. The exchange panicked. They changed the rules overnight, raised margin requirements, forced liquidation, and prevented total collapse. In 2011, when silver spiked to $49 per ounce, the ratio touched 3.5-to-1. The COMEX raised margin requirements 5 times in 8 days. They crushed the rally, forced sellers into the market, and brought the ratio back down. We are now 30% beyond the worst ratio that has ever existed, and the price still says $71, as if everything is normal. But who holds these short positions, these promises to deliver silver that doesn't exist? The Bank Participation Report, a document published monthly by the COMEX, reveals something extraordinary. 4 commercial banks, just 4 institutions, hold concentrated short positions representing more than 60% of the entire open interest. These aren't small trading positions. These are structural bets built into the architecture of the market itself. When silver prices rise, these institutions face margin calls, potential delivery obligations, and losses that can cascade through their derivative books. So the price doesn't rise, at least not on paper. Every month, during the last few days before futures contracts expire, something predictable happens. Large sell orders hit the market during Asian trading hours. When liquidity is thin, the price drops, settlement occurs at suppressed levels, physical delivery demands get rolled forward, or settled in cash instead of metal. The system survives another month. This isn't conspiracy theory. This is documented trading pattern analysis, visible in exchange data, repeated month after month, year after year. The derivatives market has become a price control mechanism, not a price discovery mechanism, and it works until physical metal disappears, which is exactly what just happened on January 1st. Because while traders in New York were pricing silver at $71, industrial buyers in Shanghai were paying $79.50 for the exact same metal, an $8 premium. That premium is a scream from the physical market, telling anyone who will listen that paper prices have detached from reality. The chair looks stable. Everyone is sitting comfortably, but 3 legs are already gone. In China, the world's largest silver producer, just removed the 4th leg. What happens next isn't a prediction, it's mathematics, and mathematics doesn't negotiate. 300 miles northwest of Shanghai, in a small refining facility in Jiangxi province, a production manager received a government notice on December 15, 2025. The document was 17 pages long. It outlined new export licensing requirements, compliance standards, documentation procedures, and approval workflows that would take effect in 16 days. This manager, who had been exporting refined silver to European electronics manufacturers for 12 years, read through the requirements twice. Then he made a phone call to his largest customer in Germany. We cannot ship after January 1st. Not because his refinery was shutting down, not because silver production was stopping, because compliance was impossible. The same conversation happened in 230 facilities across China during the final 2 weeks of December. Small to mid-sized refiners, family operations, regional processors, all receiving the same message. New rules, 16 days. Full compliance required. The Chinese government calls this an export licensing system. On paper, it sounds reasonable, even responsible. Better tracking, quality control, environmental standards, trade transparency. But here's what the policy actually does. It requires English language documentation, certified translations, government relationship networks, legal teams, and bureaucratic infrastructure that 90% of Chinese silver refiners simply do not have. The 10% who do have it are state-owned enterprises, large operations, directly connected to government ministries, with compliance departments and international trade experience. These state refiners produced approximately 30 million ounces in 2025. The other 90%, the small and mid-size operations, produced 250 million ounces. Do the mathematics. China produced 280 million ounces of silver last year, making it the world's largest producer. But only 30 million ounces can now legally leave the country. 250 million ounces gone from global supply, not over years, overnight. And this isn't China's first time running this exact playbook. In 2010, China implemented export restrictions on rare earth elements, 17 metals, critical for electronics, defense systems, renewable energy, modern manufacturing. China controlled 97% of global production. The restrictions came suddenly, with complex licensing requirements, bureaucratic layers, and compliance standards that favored large state operations. Within 18 months, global rare earth prices increased by 450%. Western manufacturers scrambled, tried to develop alternative sources, failed, and eventually accepted Chinese pricing terms. In 2023, China did it again with gallium and germanium, 2 metals essential for semiconductor production, fiber optics, solar cells, military applications. Export controls announced, licensing requirements implemented, and global supply chains disrupted within weeks. The pattern is consistent. Control production, implement complex export barriers, watch prices rise, let foreign industries panic, then dictate terms. Silver is following the exact same blueprint, but silver is different than rare earths or gallium. Because silver isn't just an industrial input. Silver is money. It has been for 5,000 years. And right now, industrial demand alone consumes 520 million ounces annually. Solar panel manufacturing needs 130 million ounces, because every panel requires silver paste for conductivity. Electronics production, smartphones, computers, automotive systems, medical devices consumes 220 million ounces. Water purification, military applications, medical equipment, another 170 million ounces. That's existing demand before any investor buying, before any monetary demand, before any safe haven accumulation. The world was already running a supply deficit of 40 million ounces per year. China just removed 250 million ounces from circulation. That's not a deficit anymore, that's a structural crisis. And here's what makes this different from previous Chinese resource plays: the timing. This happened on January 1st, 2026, exactly when global derivatives markets were holding the highest paper-to-physical ratio in history, exactly when COMEX registered inventory sat at 31 million ounces, backing 140 million ounces in outstanding contracts. Exactly when financial institutions held concentrated short positions, expecting business as usual. China didn't announce this policy months in advance. 16 days notice. Implementation on New Year's Day, when Western markets were closed, when trading desks were understaffed, when nobody was paying attention. That small refinery manager in Jiangxi province, the one who called his German customer, his facility is still running, still producing silver, still refining ore into metal. But now that silver stays in China, it goes to Chinese manufacturers, Chinese industrial users, Chinese government stockpiles, and the rest of the world gets 30 million ounces from compliant state exporters. If they're lucky, Western traders are still pricing silver at $71 because their screens, their algorithms, their models don't yet understand what just happened. But in Shanghai, physical buyers understand perfectly. That's why they're paying $79.50. A procurement officer for a German solar panel manufacturer logged into his trading terminal on January 6, 2026. He needed to secure 2 million ounces of silver for Q1 production. Standard quarterly purchase, routine transaction, something he'd done 47 times over the past 12 years. He entered his order, targeting $71 per ounce, the current COMEX futures price. Then he waited. 6 hours later, his phone rang. His metals broker in London, voice tight with stress, delivered news that didn't make sense. Shanghai physical delivery is $79.50, and the delivery timeline is 8 weeks. 8 weeks. For a procurement officer who had never waited more than 2 weeks for silver delivery in his entire career, this wasn't just unusual, it was impossible. What do you mean 8 weeks? The futures price is 71. His broker paused. The futures price and the physical price are no longer the same thing. Welcome to market bifurcation. On December 30th, 2025, 2 days before China's export licensing took effect, the Shanghai Futures Exchange physical silver premium hit $8.50 over COMEX futures prices. Not 8 cents, $8.50. A 12% premium for the exact same metal traded on the exact same planet in the exact same moment. This wasn't a temporary glitch. This was the physical market screaming a warning that the paper market refused to hear. When buyers in Asia are paying $79.50 per ounce, while traders in New York are settling contracts at $71, you're watching two completely different markets price the same commodity. And that divergence, that gap between paper and physical, is the sound of a system breaking in real time. Let's understand what this premium actually means. In normal markets, when Shanghai prices rise above New York prices, arbitrage traders immediately step in. They buy cheap in New York, sell expensive in Shanghai, and the price gap closes within hours. It's automatic. It's mathematical. It's how global markets maintain equilibrium. But in January 2026, that arbitrage became impossible because you cannot arbitrage what you cannot deliver. Those COMEX futures contracts trading at $71, they're cash settled. Paper profits, paper losses, numbers on screens, electronic transfers between accounts. But that German procurement officer, he doesn't need paper profits. He needs physical silver delivered to his manufacturing facility so his production line can keep running. And physical silver, the kind you can actually touch, the kind that actually exists in a warehouse, is trading $8 higher. The premium reveals everything. It tells you that industrial buyers, people who need silver to manufacture actual products, have already figured out that supply is vanishing. They're bidding prices higher, accepting longer delivery times and paying premiums, because the alternative is shutting down production lines. In August 2024, a temporary refinery disruption in Peru created a brief supply squeeze. Shanghai premiums spiked to $4 over COMEX. Within 3 weeks, refineries restarted, supply normalized, and premiums collapsed back to normal levels of 50 cents. 3 weeks. But January 2026 isn't a temporary refinery outage. This is a permanent structural change implemented by the world's largest silver producer with no reversal mechanism, and the premium isn't collapsing. It's widening. By January 10th, physical buyers in Shanghai were paying $82 per ounce. COMEX futures, still $71. $11 spread. Now watch what happens in the derivatives market when physical delivery becomes unavailable. The February 2026 COMEX silver contract, scheduled for first notice day on January 28th, should be showing normal rollover patterns. Traders who don't want physical delivery typically roll their positions into March or April contracts well before expiration. But something unusual is happening. Open interest in the February contract is increasing, not decreasing. That means traders are maintaining positions, moving closer to delivery, betting that they can demand physical settlement. At the same time, exchange for physical transactions, where futures positions convert to physical metal, have spiked to 3 times normal volume. Traders are trying to escape paper exposure and get into physical metal before the system realizes it cannot deliver. Lease rates, The cost of borrowing silver in the London market jumped from 0.5% annually to 3.2% in the first week of January. That's a six-fold increase. Lease rates spike when physical metal becomes scarce, when holders refuse to lend, when industrial users desperately need supply. It's another scream from the physical market. But the most revealing signal, the one that proves institutional traders know something is breaking, COMEX warehouse stock movements. In the first 9 days of January, 4.2 million ounces transferred between approved warehouses. Not out of the system, just moving between facilities. Why? Because major banks and trading houses are repositioning inventory, preparing for delivery disputes, making sure their physical metal sits in the right legal jurisdiction when contracts start defaulting. That German procurement officer, the one who called his broker on January 6th, he ended up paying $81 per ounce for immediate delivery, $10 over the market price that his screen was showing, and he considered himself lucky because his competitors, the ones who waited, hoping prices would drop back to 71, they're still waiting. Their production lines are idle, their customers are canceling orders, and silver, real silver, the kind you can actually use, is nowhere to be found at $71 per ounce. The paper market says one thing, the physical market is screaming another, and when that gap becomes too wide, mathematics forces resolution. A risk analyst at a London Bullion bank received an unusual request on January 14th, 2026. Senior management wanted a logistics assessment. How quickly could the bank process, refine, and redistribute 73.9 tons of gold if it suddenly became available on international markets? Not hypothetically, actually available. The analyst knew exactly what 73.9 tons represented. Venezuela's documented gold reserves. She opened her assessment model, ran the calculations, and delivered her answer within 2 hours. 14 days for complete processing. Assuming standard refining protocols and existing vault capacity, 2 weeks. That's how long it takes to absorb an entire nation's gold reserves into global markets, when the infrastructure is already prepared. And the infrastructure is already prepared. This isn't speculation. This is pattern recognition. In 2011, Libya held 143 tons of gold reserves. Colonel Gaddafi had been accumulating gold, building reserves, planning to launch a gold-backed currency for African trade. When NATO intervention began in March 2011, those gold reserves became strategically important. By October 2011, Gaddafi was dead, the government had collapsed, and 143 tons of gold vanished from official accounting. Some reportedly ended up in French vaults. Some disappeared into private accounts. None of it stayed in Libya. In 2014, Ukraine held 36 tons of gold in its central bank reserves. In February, political upheaval triggered government transition. By March, according to Ukrainian parliamentarian Frihory Nemiria, the gold reserves had been loaded onto an unmarked plane and flown out of the country. Destination unknown. Official explanation, none. In August 2021, the United States military withdrew from Afghanistan. Within 72 hours, the Taliban controlled Kabul. Afghanistan's central bank held approximately 22 tons of gold, plus $9 billion in foreign currency reserves. The Federal Reserve immediately froze access. The gold, physically located in New York, remained frozen. Afghanistan's reserves converted into leverage, negotiating tools, political pressure points. The pattern repeats. Political instability creates opportunity. Gold reserves become available. International institutions step in. Asset redistribution occurs under emergency protocols. Now, apply this pattern to Venezuela. 73.9 tons of gold, a government under sustained international pressure, sanctions infrastructure already in place, legal ambiguity over governmental recognition, and a timing problem in silver markets that requires immediate liquidity. Venezuela's gold isn't hidden. It's documented by the World Gold Council, tracked by international agencies, and partially held in foreign custody. 31 tons sit in the Bank of England, frozen since 2018, subject to legal disputes over governmental legitimacy. Another 42 tons remain in Venezuelan central bank vaults in Caracas. But here's what makes those 42 tons vulnerable. Venezuela's economy is collapsing. Hyperinflation exceeded 130,000% in 2018. Oil production, the country's primary revenue source, has dropped 75% since 2015. International sanctions prevent normal trade relationships. The government needs liquidity desperately, and gold is the only liquid asset they have. China knows this. Russia knows this. Turkey knows this. These countries have already been negotiating gold for goods arrangements with Venezuela, offering food, medicine, fuel in exchange for gold shipments. But those transactions occur at significant discounts, 20 to 30% below spot prices, because Venezuela has no negotiating leverage. They need goods immediately, and gold is their only payment option. Now add the silver market crisis into this equation. On January 1st, China removed 250 million ounces from global supply. By mid-January, physical silver premiums in Shanghai hit $11 over COMEX prices. Industrial buyers are panicking. Derivatives. Traders face impossible delivery obligations. Major financial institutions hold concentrated short positions, backed by 31 million ounces, supporting 140 million ounces in paper claims. The mathematics doesn't work. Something has to give. And when derivative positions unwind, when margin calls cascade, when institutions face delivery defaults, they need liquidity, massive amounts, immediately available, in forms that global markets will accept without question. Gold provides that liquidity, especially gold that becomes available during political transitions. Venezuela's gold reserves, if liquidated into international markets, would provide $2.9 billion at current prices. Not enough to solve a silver crisis, but enough to provide temporary liquidity, to meet immediate margin calls, to buy time while institutions unwind positions. And the timing, the coordination between silver market stress and Venezuelan political pressure, follows the exact pattern seen in Libya, Ukraine, Afghanistan. Crisis in one market creates opportunity in another. Asset seizure gets justified through political instability. International institutions benefit from both sides of the transaction. On January 17th, Reuters reported increased political tensions in Caracas, opposition leaders calling for government transition, international pressure mounting, sanctions tightening. The same day, COMEX registered silver inventory dropped to 29.3 million ounces. Two separate news items, apparently unrelated, but that risk analyst in London, the one who ran the logistics assessment, she understood the connection perfectly. Because she's seen this pattern before. Markets don't operate in isolation. Crises don't happen randomly. And when a silver trap closes, when derivative positions collapse, when institutions face systemic failure, someone's gold reserves become the emergency exit. Venezuela's 73.9 tons sits perfectly positioned, ready for extraction, waiting for crisis. And the crisis in silver markets has already begun. The question isn't whether Venezuela's gold will be targeted. The question is how quickly the infrastructure activates. Once silver markets break completely, that London analyst gave her answer. 14 days, the mathematics is already done, the logistics are already planned. All that remains is timing. And in markets running 4.5 paper claims for every ounce of physical silver, timing is measured in weeks, not months, not years, weeks.